Good morning. Why retail isn't dead? And for years, headlines claimed that retail was finished and that e commerce was taking over and that shopping centers would sit vacant and brick and mortar was obsolete. And that narrative was incomplete. And in Texas, we're proving it wrong. And retail isn't dead, it's recalibrated. And for investors, business owners, and borrowers, this shift creates opportunity, especially when paired with the right financing strategy. And as a mortgage and commercial loan broker at Medallion Funds, I see where capital's flowing. And retail is still attracting lenders, but only for the right assets in the right locations with the right structure. So let's break that down for you. What actually changed in retail? Retail didn't disappear, weak concepts did. And the sector shifted from commodity big box overexpansion and mall centered traffic models and over leveraged speculative development to where we are now with more service oriented tenants. So think medical or fitness or salons or restaurants, but also grocery anchored neighborhood centers and experience driven retail. And it helps to have high income suburban growth corridors in the mix. And in Texas, especially in Houston, in Katy, in Fulshire, and in Dallas, population growth and household formation continue to support neighborhood retail fundamentals. Consumers still want convenience, they still dine out, and they still need services close to home. That demand doesn't vanish because of Amazon. Now, let's look at why the data tells a different story. And across major Texas metros, vacancy in well located neighborhood retail remains tight, and new retail construction is more disciplined. And tenant demand for quality space is selective but stable. And cap rates have not normalized, or have normalized, but not collapsed. And retail's not in a free fall, it's just in a repricing and refinement stage. And lenders are paying attention. So let's look at why lenders still finance retail projects. And banks and private debt funds are still active in the space, and particularly they're focused on your diversification, your tenant mix. The lease rollover, is it manageable? And is the debt service coverage ratio strong? But also the location fundamentals need to be durable, and the borrowers need to have enough liquidity and experience. So, from a financing standpoint, retail loans today are structured with more conservative leverage and stronger underwriting. And that's healthy, not fatal. And if you structure the deal correctly, you can with lower leverage, you can reduce your refinance risk. And with fixed rate structures, you can stabilize long term cash flow. And SBA loans can help owner users acquire retail condos or storefronts if some of it's going to be sold off. And bridge financing can reposition vacant centers. Retail deals are getting done every week, they just require precision. So let's look at where opportunity exists. And retail opportunity in 2026 isn't about chasing distressed malls, it's about disciplined execution. So I would be looking for grocery anchored centers and growth corridors, or pads in master plan communities, or medical or dental retail conversions, or restaurant second generation spaces, or value add centers with good lease up potential. In high growth Texas suburbs, retail supply has been constrained for years, and that's a structural support for long term rent stability. Financing strategy matters more than ever right now. And the difference between a good retail deal and a failed one is often financing design. So let's look at some key considerations to set you up for success. First is the debt yield and DSCR underwrite. Make sure it's conservative and stress test your vacancy. With respect to refinance risk, avoid short maturities unless you have a clearly defined exit. Tenant credit quality, national credit tenants will reduce your perceived lender risk. And liquidity planning, have reserves, retail rewards patient capital. And this is where advisory driven mortgage brokerage matters. And at Medallion Funds, we're a little unique and we evaluate bank financing SBA 7A and 504 programs, as well as DSCR loans, bridge loans, and fixed versus floating structures. Retail isn't dead, but loose underwriting is, and that's not such a bad thing. The Texas advantage. Texas continues to benefit from population migration, corporate relocations, job growth, and a pro-business policy. And that economic engine supports retail fundamentals, particularly in suburban growth nodes. And remember, retail follows rooftops, and rooftops are growing in Texas. That math still works. So here's the final take, and that is retail isn't dead. Overbuilt, poorly located, highly leveraged retail is still struggling, whereas disciplined, well-located, service-oriented retail in growing Texas corridors remains financeable and a good investment. The opportunity isn't gone, it's just selective. And selective markets reward strategic borrowers. So if you're evaluating a retail acquisition, a refinance, or a development opportunity, let's structure it correctly from day one. Hello, my name is Bill Rapp. I work for a company called Medallion Funds, where we do commercial and residential mortgage brokerage advisory. You can visit my website at billrapponline.com to figure out how to get a hold of me. I'd love to talk to you more about your situation. Take care.